Warren Buffett, the legendary investor known as the Oracle of Omaha, has built his fortune over decades by following a set of timeless principles. With the constant ebb and flow of the economy, his wisdom remains as relevant as ever, especially in times of recession. As we look ahead to the potential challenges of a recession in 2024, there's no better time to explore the 10 strategies that Warren Buffett himself suggests for achieving financial success during such turbulent times. These strategies are not just about surviving the recession, but thriving in it. First thing to do is invest in quality companies. One of Warren Buffett's core principles is investing in quality companies. During a recession, it becomes even more critical to choose businesses that have a strong foundation and the ability to weather economic storms. Look for companies with a competitive advantage, a history of profitability, and prudent management. Buffett's Berkshire Hathaway has consistently invested in companies like Coca-Cola and Apple, which have demonstrated their resilience through various economic downturns. These companies possess durable competitive advantages, which provide a buffer during tough times. To identify quality companies, it's essential to conduct thorough research and analysis. Look at a company's financial statements, including its income statement, balance sheet, and cash flow statement. Assess its competitive position within its industry and consider the long-term growth prospects. It's also advisable to delve into the management team's track record and their strategic vision for the company. Second, you should be patient and avoid impulsive decisions. In a recession, the stock market can be extremely volatile, tempting many investors to make impulsive decisions based on fear or greed. Warren Buffett advises against this. He famously said, "The stock market is designed to transfer money from the active to the patient." During a recession, it's crucial to maintain a long-term perspective and not react to short-term fluctuations. Warren Buffett's own investment journey is a testament to the effectiveness of being patient and avoiding impulsive decisions. He has consistently adhered to his principles even when faced with market turmoil. Whether it was resisting the urge to sell during the 1970s bear market or maintaining faith in the American economy during the 2008 financial crisis, Buffett's discipline has paid off. Third thing to do is keep ample cash reserves. Having cash on hand is a vital strategy in any recession. Warren Buffett recommends keeping a significant portion of your portfolio in cash or cash equivalents, such as treasury bonds. This liquidity gives you the flexibility to take advantage of attractive investment opportunities that may arise when the market is down. Cash provides a level of safety that other investments cannot match. It's not subject to market volatility or the risk of losing value during a downturn. Having cash on hand ensures that you can cover essential expenses and unforeseen emergencies without needing to sell investments at a potentially unfavorable time. One of the primary reasons Buffett recommends holding cash is to seize attractive investment opportunities when they arise. During a recession, asset prices may plummet, creating opportunities to acquire quality assets at discounted prices. Having cash available allows you to capitalize on these opportunities and potentially earn substantial returns when the market recovers. Fourth lesson is focus on value investing. Warren Buffett's success is closely tied to his value investing philosophy. In essence, value investing involves buying undervalued stocks or assets and holding them for the long term. During a recession, market sentiment can lead to the undervaluation of quality companies. By following Buffett's approach, you can identify these opportunities and potentially acquire assets at a discount. Value investing is a cornerstone of Warren Buffett's investment philosophy, and it takes on particular significance during a recession. Value investing involves identifying and acquiring assets or securities that are trading below their intrinsic value. This strategy aligns with Buffett's belief that the market sometimes misprices assets, presenting opportunities for astute investors. Fifth thing to do is diversify wisely. Diversification is a fundamental principle of risk management, and Buffett acknowledges its importance. However, he advises against over-diversification, which can dilute the potential returns of your portfolio. During a recession, it's crucial to diversify your investments wisely, spreading risk across different asset classes and industries while concentrating on quality. Warren Buffett's own portfolio includes a mix of investments in various industries, from insurance and consumer goods to technology and energy. This diversification helps protect Berkshire Hathaway from concentrated risk while allowing the company to capitalize on opportunities across different sectors. Sixth thing to do is understand the businesses you invest in. Warren Buffett famously recommends investing in businesses you understand. In a recession, this advice becomes even more critical. If you have a deep understanding of the companies you invest in, you'll be better equipped to assess their resilience and potential for growth during challenging times. Warren Buffett's success as an investor is a testament to the effectiveness of understanding the businesses he invests in. Whether it's his investments in Coca-Cola, See's Candies, or Wells Fargo, his deep knowledge of these companies allowed him to make informed decisions and hold these investments for the long term. Seventh thing to do is seize opportunities when others are fearful. During a recession, fear can dominate the market. However, Warren Buffett has consistently emphasized that be fearful when others are greedy, and be greedy when others are fearful. This means that when the market is panicking, it can present opportunities to buy high-quality assets at lower prices. Buffett's investment in Goldman Sachs during the 2008 financial crisis is a prime example. He invested $5 billion in the company, which yielded substantial returns once the market recovered. One of Warren Buffett's most famous pieces of advice is to be fearful when others are greedy and be greedy when others are fearful. This principle underscores the significance of contrarian investing, especially during recessions when fear and uncertainty tend to dominate market sentiment. Eighth thing to do is focus on the long term. In a recession, it's easy to get caught up in the daily fluctuations of the market. However, Warren Buffett's success is built on a long-term investment horizon. He often advises investors to think of stocks as ownership in a business rather than pieces of paper to be traded. Buffett often reminds investors that over time, the stock market has tended to move upward despite periodic downturns and recessions. This historical perspective reinforces the idea that investing with a long-term horizon can help you ride out market volatility and benefit from the market's long-term growth. By maintaining a long-term perspective, you can avoid the emotional roller coaster of the market and stay committed to your investment strategy, which can be especially rewarding during and after a recession. Ninth thing to do is keep learning and adapting. Warren Buffett is a voracious reader and a lifelong learner. His dedication to acquiring knowledge and staying informed has contributed significantly to his success. In the ever-changing economic landscape, it's crucial to stay informed, adapt to new circumstances, and continually refine your investment strategy. During a recession, industries and markets may evolve, and opportunities may arise in unexpected places. Being open to learning and adapting your approach can help you navigate these changes successfully. 10th thing to do is don't time the market. Timing the market is a common mistake many investors make, especially during recessions. Warren Buffett, however, advises against trying to predict short-term market movements. He famously said, "Our favorite holding period is forever." Trying to time the market often leads to missed opportunities and increased transaction costs. Instead of trying to predict when the recession will end or when the market will bottom out, focus on building a well-diversified portfolio of quality assets and holding them for the long term. Warren Buffett's timeless principles for achieving financial success during a recession provide valuable guidance for investors in 2024 and beyond. By investing in quality companies, maintaining patience, and avoiding impulsive decisions, you can navigate the challenges of a recession with confidence. Keeping ample cash reserves, practicing value investing, and diversifying wisely can help protect your wealth and capitalize on opportunities that arise during economic downturns. Understanding the businesses you invest in, seizing opportunities when others are fearful, and focusing on the long term are essential strategies to achieve financial success. Continuing to learn and adapt your approach and avoiding the temptation to time the market can further enhance your chances of thriving in the 2024 recession. Warren Buffett's wisdom serves as a valuable roadmap for investors seeking to build and preserve wealth in challenging economic times. Thank you for sticking with me until the end. Please like, comment, and subscribe, and be sure you turn on the notification bell so you don't miss a video.